Let's take you to the scorecard here. Less than 60 minutes to go now in regulation back here on Wall Street. Stock's been down for most of the day. Home Depot, as you know by now, a drag on the Dow as its worst sales miss in 20 years is taking that stock sharply lower. Tech has been an outperformer today. You can see the Nasdaq is the only of the majors in the green today. For more on where the markets are heading from here, let's bring in Anastasia Amoroso of iCapital and Emily Roland of John Hancock Investment Management. Ladies, it's great to have you. Anastasia, let me begin with you. The scene set at the White House with these meetings over the debt ceiling. How are you thinking about this issue impacting the markets with the deadline fast approaching?
Well, the deadline is approaching, but it's really not fast in terms of policymakers' terms. Of course, Scott, you remember 2011 and how long it took to finally get a deal. And I have a very big suspicion that we're going to get to the same deadline, to the very 11th hour of it. And so the markets need to be prepared for that and the volatility. And I do take Speaker McCarthy at his word when he says that we're far apart, because as you know, the Democrats want a clean raise in the debt ceiling, and that is not at all what the Republicans want. And look, to be party neutral here, and if you look at the Congressional Budget Office, in the projections, there's serious issues that need to be tackled. Budget deficits running at 5 to 7% over the next few years. That puts us on the trajectory of 200% in terms of debt to GDP over, the next 20, 30 years. So these are serious issues, and you're not going to solve that in a single day's worth of meetings.
Yeah. Emily, how at risk do you think stocks are here?
Yeah, stocks are barely yawning amidst this phenomenon that's going on right now, where the possibility of the U.S. defaulting on its debt is no longer zero. And so we're looking at things like the VIX, which is below 20, high yield bond spreads at 470 basis points, well below their 20-year average. The S&P 500 trading at 18 times forward earnings, and the 10-year Treasury yield continuing to bounce off support between 330 and 340. So markets are really not right now, in our view, incorporating the risk of default. It will likely get resolved at the 11th hour, of course, but not without significant volatility. And I agree with Anastasia that 2011 is the best analog for today, given the political dynamics in D.C. And frankly, we saw the 10-year Treasury yield drop about 200 basis points over the course of that summer, from about 370 to about 170. And I'm not saying this is the exact same playbook. There are other dynamics at play. We had the European sovereign debt crisis sort of unfolding overseas at that time, and other elements here. But if that is the same playbook, we do think that this is a good time to embrace bonds. It makes us like fixed income even more.
Yeah. The other issue that the market, Anastasia, is dealing with is the Fed. And, I'm not sure that the market fully believes anymore that the Fed is necessarily done. We've had Paul Tudor Jones this week suggest that the Fed's done. Others have. And it was largely believed that they are. Yields are up today. 2 years near the highest it's been all month. Austin Goolsbee today, Chicago Fed, not sure if we've put enough restraint on the economy yet. He said, within the last hour or so.
Well, you can't blame the market, because look at the data that we got on retail sales today, and it is just fine, 0.4% month-over-month growth. And it really tells you that the consumer is just fine, the consumer is resilient, the consumer is spending selectively. So all of a sudden, this narrative for soft landing is really taking hold once again. And the banking turmoil that was front and center, to Emily's point, you can't discern any volatility in the equity market. So, I think that's why the markets are saying maybe the Fed still has to go 25 basis points. But I do want to mention one thing, Scott, about where the markets may actually be positioning for this debt ceiling. If you look at the 1 month volatility, and if you look at the call volatility, it is continued to come down. But if you look at the put volatility, the 90% put, for example, for 1 month out, it has not come down nearly as much. So I think there is demand for put protection out there. I think investors are trying to hedge their bets 1 month out. Whether the Fed raises rates or not, I think is the debt ceiling hedge.